Welcome back to our Ridge Follower International Tax Update. Today we are focusing on one development from the Netherlands, and it comes with a number that should get the attention of every international tax team: €1.1 million. The Dutch government has rewritten its administrative penalty guidance for Pillar 2, DAC8 and DAC9. The package combines a short period of relief with a much tougher enforcement framework for crypto asset and cross-border reporting. Here is what changed, who is exposed, and what businesses should do now. 1. What exactly has changed? The measure is decision number 2026-14582, dated the 30th of July and published in the Dutch Government Gazette on the 7th of August. It amends the Dutch Tax and Customs Administration's administrative penalty guidelines. The aim is to connect the national enforcement framework to three major European reporting regimes: the EU Pillar 2 Directive on the Global Minimum Tax, DAC8 on automatic exchange of crypto asset information, and DAC9 on exchanging data from the Globe Information Return. So this is not a new tax charge. It is the enforcement layer behind reporting systems that are becoming operational, data heavy, and increasingly interconnected across borders. The affected population therefore reaches beyond Dutch tax departments. Group reporting teams, finance functions, data owners, and crypto platforms may all contribute information on which the Dutch filing depends. 2. Pillar 2 gets temporary breathing room. Let us start with the relief. The Netherlands recognises that the first Pillar 2 reporting cycle depends on new portals, new XML files, and international exchanges of Globe data that are not yet running perfectly. For obligations under the Dutch Minimum Tax Act, whose due date falls on or before the 31st of October 2026, the authorities will not impose automatic default penalties for late filing or late payment. That protects businesses from being punished for launch phase disruption they could not reasonably avoid. But the window is narrow. From the 1st of November, the special provisions disappear and the normal automatic penalty regime returns. This is a transition measure, not a general safe harbour, and it does not excuse deliberate non-compliance, nor should teams treat it as extra project time. Its value is to absorb unavoidable implementation friction while companies complete testing, registrations, payment processes, and responsibility matrices. 3. DAC8 drives a 40-fold increase in maximum exposure. The sharpest change concerns DAC8 and the reporting of crypto assets. Crypto asset service providers are now expected to collect, validate, and report detailed customer and transaction data for EU tax residents. Under the previous Dutch framework, intentional or grossly negligent breaches of certain international information obligations could attract a maximum fine in the 4th Criminal Code category, €27,500 in 2026. The new decision moves these cases to the 6th category. The ceiling is now €1.1 million. That higher limit applies to relevant cross-border information failures and is mirrored for certain domestic reporting obligations. Importantly, the old wording encouraging restrained use of major cross-border penalties has been removed. The signal is clear. The Netherlands intends these reporting duties to have real enforcement weight. The practical exposure is not limited to a missing report. Weak customer due diligence, invalid tax identifiers, or unreconciled transaction feeds can also undermine the reliability of the data being exchanged. 4. DAC9 brings Globe data into the enforcement picture. DAC9 deals with a different dataset but follows the same policy direction. It creates an EU framework for exchanging information drawn from the Globe Information Return so that one filing can support administration across multiple member states. The Dutch amendments add a specific penalty route for failures connected with those information obligations. Where non-compliance is intentional or grossly negligent, an offence penalty can be imposed, subject to the relevant statutory category and internal coordination. This matters because a globe return is assembled across entities, jurisdictions, and accounting systems. A weakness in one local data stream can travel into a group filing and then into an international exchange. For in-scope multinationals, data lineage, knowing where each number came from, who approved it, and how it was transformed, becomes part of penalty risk management. 5. Not every mistake becomes a €1 million fine. There is an important legal distinction. A Dutch default penalty, a verzuimboete, is generally triggered by the objective fact of a missed deadline or payment. The inspector does not normally need to prove intent. An offence penalty, a vergrijpboete, is different. It is punitive and requires the tax authority to establish intent or gross negligence convincingly. The new 1.1 million euro ceiling sits in this second category. In other words, an isolated technical error is not automatically a seven-figure offence. The inspector must build a case around the taxpayer's conduct, and the proposed penalty must be coordinated internally with a specialist in formal tax law. That creates an important safeguard, although it also means that any case which proceeds is likely to have received structured internal review. Taxpayers also receive procedural protections associated with the punitive character of the sanction, making the evidence and the decision-making record especially important on both sides. 6. Governance and documentation become the real defence. For businesses, the practical issue is whether controls show reasonable care. A tax control framework that exists only on paper may become evidence of failure rather than protection. Companies need working procedures for ownership of data, validation of tax identification numbers, reconciliation of crypto transactions, review of globe files, escalation of exceptions, and proof that issues were corrected. Control should be repeatable and evidenced. A policy without test results, sign-offs, or retained exceptions will be difficult to demonstrate later. The second line of defence is the Dutch doctrine of an arguable position, plichtbaar standpunt, where Pillar 2 or DAC8 rules genuinely allow more than one defensible interpretation. A position supported by a timely legal memorandum or advisor opinion can help rebut an allegation of intent or gross negligence, even if the interpretation is later rejected. The key word is timely. The analysis should exist before the return or data file is submitted, not be reconstructed after an audit begins. 7. What should affected groups do now? 3 actions follow from this. First, Pillar 2 groups should use the remaining transition period to test Dutch filings and payments end to end, with a clear readiness date well before the 31st of October. Second, crypto asset service providers and groups using them should reconcile reportable transactions, customer classifications, and identification data against their accounting records and keep evidence of those checks. Third, tax teams should identify every material grey area, assign an owner, and document the chosen position before submission. Management should also know which failures require immediate escalation rather than a routine correction. This is now as much a governance project as a technical tax project. Systems, advisors, finance teams, and local management all need to produce one consistent audit trail. The takeaway is a deliberate 2-track policy. The Netherlands is giving Pillar 2 filers limited protection while the new system settles in, but it is simultaneously raising the stakes for failures in crypto asset and international information reporting. The headline risk is €1.1 million, yet the real dividing line will be evidence, functioning controls, credible reconciliations, and legal reasoning documented before filing. If your Dutch compliance process still depends on manual fixes at the deadline, this is the moment to redesign it. See you next time.